Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today video we're gonna talk about a high quality dividend growth stock that looks to be on sale with a nice dividend of 3%, good growth prospects, and undervalued, and technically is a good buying opportunity. So let's get started with that stock. So the stock we're going to cover is APD, Air Products and Chemicals. I'm going to read a little bit about exactly what they do. Air Products and Chemicals Inc. provides atmospheric gases, process and specialty gases, equipment, and related services in the Americas, Asia, Europe, Middle East, India, and internationally. So you can see here, there's a global company, and I like global company because of the fact that it's global. You know, their reach is much more bigger than most companies here in the U.S., but they just have the United States reach. So that's a little bit about the company. So they're a gas company, gas products, air products, and stuff like that. So you can see here, year to date, the stock is down 13%, and in a 1 year time period, is down 19.6%. But in the long term, obviously, it's up almost 17% here. But it's been kind of flat, really. The market's been up tremendously since past 5 years, and this is just up just 17%, and that's because of valuation. When you buy stocks that's overvalued, your projection of total rate of return decreases. So basically right now, what I think this is what's happening is called consolidation. So price is, or earnings is trying to catch up to price. So there's two ways of correction: either through time, like this, consolidation, where really no return, or little downside and little upside, or through price. So you have time with consolidation, with no ups and down really too much, or a correction, a pullback, 20% down, 15% down, stuff like that, a pullback where it could get into the correct valuation or fair value. So there's that. So now let's go to fast graph on Air Products. So if I remove the price, you can see here the company is outstanding. It has a few down years. Over here in 2009, it had a 20% earnings drop, and in 2017 it had a 16% earnings drop. But overall, earnings has been in the double digit for most years. Only in 2020 it had a 2% increase, in 2021 an 8% increase, and here in 2013 and 2014 2% and 5%. But overall, most years double digit return in earnings, or double digit increase in earnings. Analysts are expecting a low, mid to high earnings of 7%, 9% for 24 and 25 and 26. But some company info here: S&P credit rating of A, which is outstanding, 45.29% debt to cap. You can see here earnings has just been going great, and if we put in the price, you can see here this is that time period, that 5 year period, where the price has just been fluctuating basically. And this overvalue, you see you have a 35 PE, I think got up to 40, maybe, no, 30 PE. So you can see here earnings was still down here around 15 PE. So it's trying to catch up. So this is why consolidation or price correction corrects fair value of prices. So now if we look at this at a shorter time period, we can see that the stock actually looks fairly valued to slightly undervalued. For the most part, the stock trades at a normal multiple of 24, but again, this is based on overvaluation, but still not a bad buy because of how high quality stock this is. It has almost a 3% yield. It grows its dividend too. If we stretch this out to 15 years, you can see here it grows its dividend very nicely. Some years has double digit. The most recent increase was 10% and 14%. So you get double digit increase with a 3% current dividend yield. So I like that a lot. And earnings are continuing to expect to grow. And if the company were to revert back to a 24.8 multiple, you can see here you can have a 21% annual rate of return for the next 3 years, which is great on a high quality company. That's outstanding. I like that a lot. The only issue I see here, earnings yield is at 5. I like to see this at 6.5 and higher, but it is a high quality company. Next, if we look at operating cash flow, you can see here is covered the dividends very nicely. So dividend is very covered, and free cash flow doesn't cover the dividend. It's very capital intensive, this company, but for operating cash flow, it's good enough for me. And the S&P credit rating is great. Forecasting, if we look long-term growth, analysts are expecting the company to continue to grow about 7.8% for the next 5 years. And in normal multiple historical, when I use this, I like to use the lowest of it to make sure if I'm getting a good deal. So for the 20-year period, the average is around 19.78. So that's what currently are more or less what we get right now. And if we were to continue at that rate, we'll have 11.42% annual rate of return for the next few years. So which is still good. It's not great, but it's still good. It's not as great as the 25 normal multiple, but it's still good at 11.42 for a high quality company, a company that grows its dividends, and a company that has a high credit rating. So if we go here to Morningstar, we can see here that it is undervalued. We have price to sell of 4.23 compared to the 5-year average of 5.4. Price to earning is lower than the 5-year average. Price to cash flow is lower, and price to book is lower than the 5-year average. And the PEG ratio is higher than the 5-year average, which is all great indicators of the valuation of the company. So you can see there it is undervalued compared to the 5-year average. Growth for the past 3-year annualized revenue has been increasing 12.4% annually for the past 3 years, which is great for such a well-established company. Interest coverage outstanding 16.4. I like to see this over around 5 and higher. So this blows it out of the water at 16, and debt to equity ratio at 0.8, which is great. If we look at operating performance here, we can see that net margin has been decreasing. You can see here in 2021 it was 20%. In 2020 it was 21%. So now trailing 12 months is 18.8, with the average 5-year average is at 19. So it is lower than the 5-year average, but not too concerning. And now we look at Morningstar. They gave it a 4-star rating with a fair value price of 307 and the last price at 231. So right now the stock is going for 238. So it is a little higher than what this report comes in. But it's still undervalued of the $307 fair value that they have, with a 4-star, which is a buy rating, and a wide moat, which is great. And if we go back here against this under industry, you can see here that this stock is undervalued compared to the other competitors. You can see here this is overvalued to fairly valued here. So this is the only competitor or company in this industry that's undervalued, and it has a wide moat, where this one has a narrow moat. And the 4-star, where the other one has 2 and a 3-star. So this is great, good buying opportunity for this stock. If we go further down here, I like to look at this over here. Let's get to there, right over here. Revenue, they continue expected to grow, which is, I like that, because revenue, revenue doesn't grow, then you can have your operating income doesn't grow, your net income doesn't grow, earnings doesn't grow, and then the dividend can grow. So this is why revenue is so important to continue to grow. You can see here net income is expected to continue to grow as well, and earnings right over here expected to grow as well, and the dividend also expected to grow. So that's all good indicators. The company is still expected to continue to grow and getting earnings at a continue to grow, thus creating the price. Now we look at technically, this is why I said technically it is in a support area. You can see here in this, around this here in August, May, July, September of 2022, there was a lot of support here, a lot of battle was fought here, and around this 220 to 230 area, and it actually went a little lower. I'm upset at myself that I didn't buy here around the 220 when it dropped that day after earnings. I'm kind of upset, but I didn't saw this. I think I had an alert around $200, so I didn't knew that this happened. I would have definitely picked up a small little position there. But right now, it's not as great as a buy, like around here, around the 220, but it's a decent buy at 238. It can bounce here back to 270, and hopefully, continues higher. But I'm waiting for the 220 area before I open a position in this stock. I don't have position in here. I would like to buy shares around this 220 and then wait for around 200 to 180. This is where I'll buy some more shares if it gets to get down here, because this big support here, this was the COVID low. So I would like to buy more shares at this level. But so that's Air Products and Chemicals. I don't own shares, but this company looks undervalued. Not tremendously undervalued, but a decent undervalue for a high quality company. So I hope you guys like this video. Make sure to hit the like button, and if you're new to the channel, make sure to hit that subscribe button. I'll see you in the next one.